Let's look at some of the limitations of straight line depreciation. We haven't really critically analysed it, we've just used it. So let's look at what we know. It's a method of depreciation that charges or allocates the same amount of depreciation every reporting period. And I guess that assumes that the asset generates the same revenue every period and is used at the exact same amount. So I guess what we should ask is that actually true? Do all assets earn the same amount of revenue every period? And are they all used or consumed at the same rate every period? So looking at things like shop fittings, display equipment and furniture, they seem to be used at roughly the same amount every year. They don't sort of get less effective as they get older. They probably generate roughly about the same amount of revenue every period. So I think it's okay to charge straight line depreciation for those. But looking at things like a vehicle or equipment, machinery, maybe laptops, computers, they're things that as they get older, they get a little bit less efficient. We're probably going to be able to use them a bit less than we did the previous period. So maybe straight line depreciation is not appropriate for those types of assets. So why? Well, why shouldn't we charge straight line depreciation for, say, a car? And the reason could be it's more efficient at generating revenue in its early life compared to the final years. It usually costs more to use as it gets older. So take a car, for example, it might require servicing or repairs, can break down, becomes less reliable and less efficient. And it could be that their market value drops over time significantly as well. Now, we don't really take into consideration that last factor, but looking at these factors here, we're going to have a lot of assets that meet this criteria. Their revenue generating capacity says they're going to be able to generate less as they get older. So we should start charging less depreciation as they get older. But at the moment, straight line doesn't do that. So what we've been assuming is take this van here. It's going to generate $25,000 of revenue in year one. So we charge $10,000 of depreciation in year one. In year two, it generates the exact same amount of revenue. And that's probably not true. But we've been assuming that because we've been charging $10,000 of depreciation. It stayed exactly the same. In year three, we've kept it exactly the same again. Now that's not realistic. In the real world, a car is going to get less efficient in generating revenue every period, and therefore we really shouldn't charge the same amount of depreciation. So what's probably more likely is it might generate $25,000 of revenue in year one, and therefore we charge $10,000 of depreciation. But in year two, instead of saying $25,000 of revenue is generated, maybe only $17,500 is, because it's less efficient. But using straight line depreciation, we've charged the exact same amount of depreciation. So if you look here, we said the expense is the exact same, but that doesn't really make sense because in reality, it's probably going to get used to generate less revenue. And then going forward, it makes even less sense. Maybe in the last year of the car, it breaks down a lot, gets less efficient. We can only generate $10,000 of revenue. But again, we've charged $10,000 of depreciation. So using the straight line method doesn't seem to make sense for an asset that's like a car. So why did it generate less revenue? This car in particular, it was servicing was needed, repairs were needed, it was off the road for servicing and repairs. So that means you can't use it to generate revenue. It's going to use more fuel as it gets less efficient, and it's just going to break down and become less reliable. So maybe it makes sense to assume the car is going to generate less revenue each and every year. So I think that's a fair assumption. I guess what's not a fair assumption is, well, why would we charge the exact same amount of depreciation every period? So we should actually have the depreciation going down. So what we need is a method that will allow us to do that. And so in this case, we charge $10,000 in year one, $7,000 in year two, and maybe $5,000 in year three. So that seems to more accurately match revenues with expenses, which helps fulfill our reporting period principle. And we're going to get a better, more accurate net profit, so that helps us fulfill relevance. And we just need a method now to help us do that, and that method's called the reducing balance method.